The market at a tipping point on hopes of a possible trade deal at the G20 this weekend. Wall Street trying to guess what will happen next as stocks hover near record highs for the third time in a year. Our next guest, though, says even a deal won't save the markets. Let's bring in one of the biggest bears on Wall Street, Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Welcome back. You like being described that way? Are you one of the biggest bears?
Well, I'm more than one of the skeptical people out there, right? I don't think that. I mean, look, this has been a 1-2 punch. We've been talking about it for over a month. The Fed and trade, and can this get us through 3,000 finally? And I don't think that's what's going to happen. I think what's going to happen is we had the news from the Fed. I think it's good, right? It's not like December. That's going to help. But the issue here is that we're having a business cycle that's slowing. It's been slowing. So fundamentally, our call has been more right than I even hoped this year, right? CapEx is disappointed. Inventories are bloated, right? The ISMs are now rolling over. Things are slowing materially, and you can't blame it all on trade. So let's say we get a trade deal, right? This looks very similar to the meeting in November in Argentina, the G20. By the way, also end of the month, all right? They go there, there's a trade truce. Everybody comes back on Monday, big pop, 1.5%, and then December was December, okay? Now, I don't think it'll be that bad, but think about if you're a procurement manager, right? And there's a trade deal, and you come back and say, oh, actually, there's a deal. I don't have to worry about tariffs going up. I'm going to burn that inventory down even faster, and that's kind of what happened in December. So to me, I'm not expecting a big deal. No, I don't think anybody's expecting a big deal.
What if you just get, no additional tariffs for the time being, for another 6 months?
That's what we expect.
And the Fed cuts rates in July.
I think that's a positive, right? So that's why the market's trading at 29.50 again, right? We're pricing that in. But look, I think the big debate now is around the Fed. The Fed, to me, is more important than trade. And here's why. If the Fed's cutting for insurance reasons, right, they're taking out an insurance policy, this is positive. If the Fed is cutting because it's end of the cycle and we're about to have 3, 4, 5, 6 cuts over the course of the next year, which is what the bond market's kind of saying.
Maybe the bond market's wrong because Powell's not suggesting that even this week.
That's right. But think about this, Scott. If you're the Fed chair, right, and you're trying to get sentiment back up and confidence up, even if you felt like things were getting worse, you're not going to say that, right? You're going to say we're doing this to potentially, stave off concern about trade. And we're doing this to potentially stave off concerns we're seeing in the corporate sentiment numbers, right? You're not going to come out and say, hey, we're worried about a recession.
Would you agree that it feels more preemptive than reactive, or however you would characterize if they thought something was really terrible?
No, I think this is very reactive. I think what they're doing, and by the way, it's appropriate. I think that the data has been really, really bad. Okay, so if we go through the numbers, we talked about it the last time we were here. Freight index, right? The ISMs are very, very weak, and our leading indicators are suggesting they're going to get even weaker. Consumer confidence this week was really poor.
That was bad.
Retail earnings have been quite soft. Gasoline prices, oil prices have been coming in significantly, which is a signal of demand being weaker, right? Small cap stocks have been underperforming. Banks have been underperforming. Those are domestically oriented businesses, so this is not all about trade. I think this is reactive. I think it's reactive to data that's slowing, and I think it's appropriate that they're reacting. And that's why we have a 50 basis point cut forecasted for July, not 25.
Well, why do you think that Powell is so on the bubble then? All the things that you just went down, that litany of reasons why he should be cutting. So if you're a short seller, though, in the market, let me just give you the setup. Obviously, you named it, the trade war, and then if that eases, and then you have Powell with 2 or 3 cuts in his back pocket. Those are the positive things that you don't want to short it. Is he just lingering it out to save that ammo? Because once he cuts, he thinks that people are just going to start selling with both hands?
Well, look, one of the Fed's biggest tools is jawboning, right? Signaling, right? Just the pause alone in January led to a 25% rally. So it's powerful to signal. And so they want to use all those tools in a sequential manner. They don't want to throw them all out there at once, which is why we were talking about earlier, they didn't end QE prematurely or QT prematurely. They're going to continue with the tapering. They could, but that's another tool that they could pull out. I think the Fed is going to be aggressive. And I think the Fed's going to be aggressive for reasons that are not necessarily bullish. They could win. Historically, though, when the Fed begins a new rate cutting cycle, it's typically not a positive event for stocks over the next 6 months. Okay,
Timmy?
So, Mike, you talked about the Fed. A preemptive Fed is a bullish Fed for the market as opposed to a reactive. You get to a place where also the Fed often has tried to tell us for the last 5 years they're all about data dependent, and we're going to wait for the data. So it gets to a place where I get the sense, and I can't tell if you think that the market is ahead of the Fed or not. Can you clarify that? Because to me, whether it's 2% GDP, which I realize is what we probably have in the second quarter, I don't see where the Fed should be going 100 basis points, which is what the market is putting a high probability, 75% we do that before the end of the year.
Sure, that's right. I think the bond market is definitely ahead of where the Fed is today in action, but not at their words. I mean, I think the Fed has been aggressive with their jawboning, and I think they are kind of telling you they're going to give you a lot over the course of the next year. So, I mean, look, this is the yin and yang that always happens at this stage of the cycle. You know, going back again to the data dependency, another reason why they didn't cut rates last week is we don't know, right? They do want to see the data next week. We have three big numbers. We have the ISMs, we have the jobs numbers on Thursday and Friday. Okay, it's also a holiday week. And then they want to see that. They want to see that data, and I think that's appropriate. By the way, there's also a big meeting this weekend. And if there is a deal, there could be, maybe there's a bigger deal than we're expecting, then maybe they don't have to go as aggressively. They want to keep those bullets in their pockets.
So explain to me the sector picks you have of staples, financials, and utilities.
So
how does that all work? Where financials play into that is curious to me.
Yeah. So we've had the defensive rotation on for the last year. It's worked really, really well. And that has been a bond proxy call. Okay?
Sure. I get that.
The financials, okay, now if the Fed is going to start cutting aggressively, which we think they are, the curve is going to start to steepen again quickly. That's what happens. Typically, once you enter that phase, it's pretty good for the financials. By the way, parts of financials have worked. Insurance has worked really, really well. It's late cycle. The banks are early cycle. So it's kind of a hedge position because you can't be fully defensive in your positioning, right? So we have defensives over here, and then we have one early cycle group over here.
Last question, who wants it?
Listen, you know, I kind of view what's going on with interest rates in the stock market. It's kind of like Tim's haircut. It's kind of business in the front, party in the back a little bit. I've never seen anything like this. We have the 10-year Treasury at 2%, and we have the S&P looks like it's going to break out of an 18-month trading range. And so I guess the question is, Mike, you just mentioned rate cut cycles. It's not usually good for stocks. The last couple times it hasn't. So who the heck is buying stocks for a breakout here when bonds are telling us that growth is slowing and they're going lower?
Let's not forget, Dan, the S&P 500 is the most defensive stock market in the world. Okay, global stock markets have had a rough time the last 18 months. So anybody who has to own stocks is owning S&P 500. Russell 2000 is not near the highs. Okay, even the Nasdaq didn't make a new high last week when the S&P did. So if you know, cyclical stocks are underperforming. So I think if you actually listen to what the market's been saying, it's actually not so far away from bonds as people might think. It's been trading very defensively. And yeah, we think we're going to stay in that consolidation. That's been our call for 18 months. We think we're going to get rejected here again at 3,000. Maybe we pop over it quickly on Monday. We'll see.